radio for a really great future. We're talking real money.
Every single week on a Friday, I try to take a whole lot of your questions here on the Talking Real Money Q&A Friday podcast. It's become a tradition. Hi, everybody. I'm Don McDonald, and please keep sending those questions in. Actually, we could probably use a few more if you like these question-heavy Friday shows. If you want me to go back to 4 questions, okay, I may have to do that next week if I don't get a bunch more, but I probably will. So keep them coming in. You send your questions in this way. Go to talkingrealmoney.com. Then you'll see the Contact Us button up there in the corner. Click on that. Then, when you get to that form, instead of typing your question, those go to Tom, which makes him happy. But if you want to make me happy, then record your question right there in the website using your phone or your pad, your iPad, or your computer's microphone or whatever. The better the mic, the better it sounds. But they all sound pretty good these days. So do that, and then I'll answer them. And I'm going to start this one off with a question that I said I wasn't going to take again, but this one is, I think it's worthy of discussion. So here's the first question.
Hey, Don, I've been listening to all this talk about the debasement trade. Could you explain that? Thanks.
For those of you just joining the podcast, that is Bitcoin Bob. Bitcoin Bob calls several times a week, and I used to put his questions on, but they just got tired. He's always arguing for Bitcoin and cryptocurrencies. And honestly, I don't know why he still listens, because he hates everything I have to say about cryptos. But hey, I'm glad he listens, I guess. And so I thought, debasement. Now that's something kind of interesting, because what he's talking about is the decline in value of currencies, traditional currencies, dollars, pounds, yen, euros, that kind of thing, pesos. And that is something that is not necessarily an evil. Some will see it as an evil, but it's generally, most of the time, a very gradual thing. The debasement of currencies. The debasement of currencies occurs in an inflationary environment. The currency becomes less, the prices you pay for things gets higher. And currencies have traditionally devalued over time, pretty much across the board. I mean, if you look back at what the dollar was worth 150 years ago, it was worth a lot more than it is today. But it's a gradual thing, and it's something that we live with reasonably well. It's not like something that happens all at once. The value of currencies tends to shrink, and they all tend to shrink against each other, although one will be a little higher at times than another. The U.S. dollar for a while was much stronger than other foreign currencies. Now they've become a little stronger and ours a little less. But since 2010, the U.S. dollar has lost about 25% of its purchasing power to inflation. Now, that's over 15 years. Now, you could say that's bad, that's volatile, but what's the alternative to that? Some will say it's gold, and that argument's been made for hundreds of years, that we should have a hard asset-based currency, and maybe you agree, maybe you don't. I tend not to agree, but we all have our prerogatives. But folks like Bob really believe that the alternative, the best alternative, is a fixed currency like Bitcoin. Bitcoin is going to get so big and no bigger. You can't print more Bitcoin. And again, that's a super simplistic way of describing inflation too, with dollars or yen or pounds or whatever it is. But the one thing about the U.S. dollar and all those other currencies is that they tend to be historically pretty darn stable. Now, would you want to replace the U.S. dollar with a currency that since 2010, over that same period, has had more than 12 declines of 50% or better. Is that a better currency? I mean, that actually makes Argentina's peso look stable. The dollar is a lot less volatile than Bitcoin. It's not a great replacement. I mean, let's see, what's a good analogy? Let's compare the dollar to like a melting ice cube. It's just at room temperature, it's melting. Bitcoin is like putting that ice cube in a frying pan. And here's what I believe to be as close to a fact as we can get in this world where nobody agrees on what facts are anymore. If you want to hedge against the erosion of money, of currencies, you don't buy a casino chip. It might make you more, it might make you less. Historically, what has worked is buying productive assets. In other words, things that in and of themselves create more value over time. I'm talking about businesses as reflected in the broader stock market, the total market. I'm even talking real estate. You know, it at least has potential to be made more valuable. Gold, the only way you make gold more valuable is to turn it into something else, and the problem with that is it's not very liquid. In other words, invest in the stock market. If that's your belief, Bob and others, that the dollar is going to keep falling in value, then buy businesses. And don't just buy them here. Buy them all over the world. I believe that is a much better bet than Bitcoin, which is just gambling, in my opinion, still. But thanks for that question. Now let's go to our next question from somebody on a different topic entirely.
Hey, Tom and Don. I have a question for you about target date funds. So let's say a person invests all their money in a target date fund, and another person invests their money in a 3-fund portfolio of total market US, total international, and total bond. And they go into retirement with the same split, just in 3 different funds versus a target date fund. How much more money would the one in the 3-fund portfolio how much more money would they make in retirement, and how much more would they be able to withdraw on kind of like the last 25 years, for example? Like, I assume that philosophy would make more because they could sell the winners and sit on the losers until they recover. But I know a target date fund also rebalances every day. So I would just be curious to hear some thoughtful analysis on that question. Thanks so much.
Well, broadly, there shouldn't be much difference between you building your own well-diversified stock and bond portfolio and a comparable target date fund. There is no inherent difference that is going to enhance or detract from the yield one way or the other. There really isn't, except for the fact that you now have more control over your allocation. But if you're talking about a static allocation, then 6 one way, half a dozen the other, if it was static the whole time. But that's the thing about these target date funds, is that they glide path. For example, the Vanguard Target 2055, 30 years out. It is 90% equities, 10% bonds. Now, it doesn't have the same percentage of international as I'd like to see, but it's decent enough. And what that fund will do over time is gradually move toward that 66-33 or that 60-40 or 50-50 on the way to retirement, assuming that age is the only determinant in volatility comfort, which I don't believe it is. The advantage to doing it yourself, that 3-fund portfolio, is that you could initially do that 90-10, and yet you could decide that, you're in later on, you don't want to be that conservative. You're comfortable with risk. You'd rather make more. the heavier you're allocated toward equities, the more likely it is that you will make more money over time. That is the biggest determinant. How much you have in equities and time generally have led in the past to higher returns. So it really doesn't matter whether it's a target date product or your own fund that you're glide pathing to your personal risk profile, risk need, and tolerance. But there really should not be an inherent difference between something. Now let's go to our next question that came in at talkingrealmoney.com on the contact form.
Hi, Tom. This is Slade in Virginia. I have a few details I'd like you to hear to see if you can help guide me into next steps or some reallocation of my brokerage account. My wife and I are both 44 years old and have an 11-year-old daughter. In the next 5 to 7 years, we are both looking to early retire or switch to careers that pay much less and would like your thoughts on withdrawal order and allocation. We spend about $115,000 a year. Currently, all of our tax-deferred and tax-free retirement are located in about 60% S&P 500, 15% international, 15% small cap, and about 10% mid cap. We have about $1 million in traditional retirement and $372,000 in Roth. We also have about $36,000 in HSA, $75,000 in 529. Our taxable brokerage, however, is worth about $685,000 and is split between around 85% S&P 500 funds and 15% small cap. Over the next 5 to 7 years, if we want to live off the taxable brokerage after that, should we start heavily working bonds into that allocation to de-risk? Should we consider a 72T? Looking for any guidance. Thanks so much.
Well, I don't know if I should answer your question since you directed it to Tom, but I'm kidding. I know that was just a mistake. Hey, it's another one of those it depends kinds of things. Thanks for all the information. You're doing at your age incredibly well. And the reason I say it depends because it does. It depends on when you want to retire. Because if you want to retire at 45, then you have some work to do. Unless you're going to cut way back on your lifestyle. You don't have the means right now. You're getting very close, but you really can't support $115,000 adjusted for inflation lifestyle. I don't think you can do it. And it would definitely require a 72T, which, for those of you who don't know what a 72T is, that's a way to avoid the 10% penalty on withdrawals from an IRA, a retirement account, qualified retirement account like a 401k too. You're required to take what the IRS calls, and there's a formula for this, substantially equal payments for 5 years or 59 and a half, whichever is longer. So if you retired at 50, it would be 9.5 years that you must take these substantially equal payments. After that, then you can adjust the payment. That avoids the 10% penalty. It does not avoid the tax. To do what you want to do younger would probably require a 72T on that $1 million. I'm sorry. Yeah, the million plus that's in retirement accounts, because the taxable account will never support it. As for bonds, you need bonds when you fear volatility. When you believe that volatility, the portfolio volatility that occurs more often on the stock side, is likely to cause you to panic and do something dumb. And I like to use the argument, well, in your case, let's say $2 million. You have $2 million and all of it is in the stock market, and in 1 week, 2 weeks, 3 weeks, a month, suddenly that goes from $2 million to $1 million. What are you going to do? If you might change your portfolio allocation in reaction to that, then you need to start adding bonds. Now, how much? Again, depends on your risk tolerance. But you're doing a great job, and you're certainly on track to meet your goal. It just really depends on when you plan to partially or fully early retire. And Of course, we believe you should take from the taxable account first and let the tax-deferred accounts ride for as long as possible. So it might be that you live off that taxable account until it's getting close to running out, and then you 72T out of the retirement accounts. So, but I can tell you one thing. With the size of the account you have and your ambition, you need a plan. You need a written plan, and you can definitely afford to pay for one. You should have it. Thanks for the question. I think we have two more. Let's go to the next one.
Hey, Don and Tom, just curious about what each of your equity to bond allocation is at your current age. Thanks for all y'all do.
Well, you're welcome. And I can't speak for Tom, although the last time I heard him mention it, I think he said 70-30, although I cannot. No, I'm not 100% certain. He may have said 80-20, but I think he's 70-30. I was 70-30, and I'm working my way towards 60-40 right now, gradually. Only because I'm getting closer to wanting to start drawing that money out. So I'm trying to I'm glide pathing it a little bit. I think I'm about 65-35. So I don't know why that's relevant, but I just want to answer the question because everybody's different and everybody should be doing it differently depending on their personal risk profile, which is risk need, risk tolerance combined together. Thanks for the call. And now, well, see, time flies when you're having fun. Here's the last one.
Hey, Tom and Don. This is Jason from Indiana. I was just wondering, I have the holding VT, the stock ticker VT, and China makes up about 3% of that stock. If anything were to happen with China and us, like if we were to go to war or anything like that, what would happen to that 3% of Chinese stock? Would it get dropped? Would it get held? If you can answer that, I appreciate it. Thanks. Bye.
Well, it's a hypothetical scenario, but I guess it could happen. What would likely happen? That Chinese ownership is generally through American depository receipts. For example, Alibaba, which is a Chinese company, is traded on, I think it's the New York Stock Exchange, but it's using an American depository receipt that owns shares in Alibaba that are in I think it's a Cayman Islands holding company. It's all very complicated. But what would likely happen in an all-out war with China is that those ADRs would stop trading because there's no way that the U.S. government is going to allow money to flow into Chinese companies to help their war effort. It's just not going to happen. Plus, the Chinese aren't going to let us trade in their securities. So I am pretty darn sure that every single Chinese holding either trades on Hong Kong directly or as an American depository receipt, an ADR, which means that in almost any scenario of all-out war, I mean, truly shooting war, we've declared war on each other, horrible conflagration kind of war, you're going to have bigger things to worry about than your 3% in China, but you're probably going to, or your expectation should be that is a 3% permanent or darn close to permanent loss. That 3% is gone. That's why you should never have a major portion of your portfolio in any emerging market anywhere in the world. I have said for literally decades that I would not want to have much, if any, money in China, not for the war reason, but because of the governance issues with having your money in a country that is basically a totalitarian government. Although it's worked out so far, it just is at 3%, it's not a lot. It's a tolerable, definitely a tolerable loss of a portfolio that's that well diversified. And it speaks to the power of diversification. Yeah, Worst case scenario, you lose 3% directly because of the Chinese-U.S. war. What it might do elsewhere, who knows? The rest of the economy, the rest of the global economy, how would it be affected? Would there be one? Probably. There was one after that last gigantic, horrible, multi-million death conflagration we idiot humans embarked upon in the 30s. 3%. That's my final answer. 855-935-TALK is our phone number. That's how you can call us on Saturdays and talk about money live with both Tom and me on our radio show. Saturdays, 3 p.m. to 5 p.m. Eastern, 855-935-TALK. Otherwise, we take questions 24/7 at talkingrealmoney.com on the contact form. We also encourage you to don't leave this stuff to chance or to possibly a bad broker or even worse, an insurance agent who used to be a bad broker, and get some free help, at least a glance at your portfolio to see if you're on the right track by setting up an appointment with one of our Appella advisors. It's really easy. You go to talkingrealmoney.com and you click Meet an Advisor. You can even meet with Tom if you want. He likes that. He does. He enjoys it. I'm sorry, I'm too busy making podcasts, but he loves having meetings with people. I know. We're so different. All right. Thanks for being there. By the way, do go to talkingrealmoney.com and speak in some more questions, because I'm down to the point where if I don't get several more, next week we're going to go to 4 questions instead of 5. I was going to do 6 this week, but I decided I'd keep some in reserve. So send them in, talkingrealmoney.com. And thank you so much for listening. Tell a friend or 2 or 10, and keep listening almost every day as we, Tom and me, are talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.